public is a movie.
Yeah.
They'll rewind it. They'll rewatch that other part. It's like, you better freaking get it right.
Yeah, no, that's very true. CEOs who I think handle that best, and the more experienced CEOs I think have gotten used. It is, in biotech, it's not seen, and you kind of refer to it with how we approach in the public generally, but it's not seen as a positive to be really promotional.
Yeah.
It's seen as a positive to be kind of conservative.
Well, Mark, thanks a lot for coming. I know Boba isn't your thing, so you have a backup coffee. Appreciate that. You want to do your disclaimer?
Sure.
We'll put it front and center.
Thank you. So these are my views that we'll talk about today, not necessarily my employer Stifel's views. So that is the disclaimer.
Mark has the spiciest views. All right, so I think most people don't actually know what a banker does, or they pretend they do, but they don't actually know what you guys do. So do you want to describe like what you guys do and how did you get into it in the first place?
So my background, I work for Stifel, as I talked about. I became an investment banker after going to business school in 1999. I spent 5 years at JP Morgan in their M&A group, and then 5 years at Bank of America in their healthcare group before I moved to Thomas Weisel, which eventually was bought a couple of years later by Stifel. So I've been with Stifel since 2010. And pretty much from the time I moved to B of A back in 2003 until today, I've been a biotech banker. Before that, I was M&A across a bunch of different industries. So I guess your question about what do bankers do? So our jobs generally is to build relationships with companies and investors, but mainly companies on our side of the wall. As banks overall are kind of set up, there's a public side and a private side, right? So the public side is our public equity sales force. We have a public debt sales force, and then our research departments there's debt research and equity research. A lot of biotech companies are obviously more familiar with the equity side. And so that's the public side. They work just on public knowledge. They're on one side of the wall, which we call the wall that's in the middle. And then there's the private side, and that's the banking people. And then other people you've heard, equity capital markets, debt capital markets, M&A product people, they're all kind of on that side of the wall. So as a industry banker, my job is to build relationships. Biotech companies, get to know CEOs, CFOs, board members, and look for opportunities where they need to use our services. And in biotech, obviously, a lot of that is equity capital raising. But we also do M&A. We do collaboration, advisory on collaborations, and some other generally restructuring and things like that. But the bulk for most biotech bankers out there, the bulk of our business is equity capital markets.
And so like, I remember when we first met, I was confused about like, wait, why do the bankers want to talk right now? Like, what is there to talk about? Like, we're not trying to go public. So why are we doing this? What are the reasons that you guys try to start so early? Now I understand why you were doing that, but at the time, like, why are we even talking?
Well, it's a good, and you should answer your own question there to a certain extent because you saw the difference. I think for us, building a relationship early helps us to get to know the company better, helps us to get to know the management team better. And, a lot of this relationship is an advisory type of relationship. And so it's important that that both sides kind of trust each other and get to know each other a little bit. And so I definitely like to start early. I've taken companies public where I've known management teams for 5-6 years. I've taken companies public where I've known management teams through multiple companies, so over 10, 15, 20 years. And that's helpful because then we can have a conversation about when is the right time to go public. Is my advice, I think, and the management team looks at that advice and kind of says, we know this person. He's not just, trying to do it because he's trying to push a transaction. He's doing it because he's got real rationale for this advice, right? So building that trust, I think, is the most important thing. And that's why starting early, I think, is more helpful.
Well, you were one of the unique ones that I feel like through thick and thin, that trustworthy, good advice was always there. I think some others behaved different ways sometimes. But I think the part that like I also didn't appreciate from those early points was that related to your guys' like trust and relationship building exercise, you'll actually try to help. Like, hey, we're wondering about this space. You're like, oh, I'll throw my analyst on it and here you go. I'm like, oh, so like we don't have to pay consultants like tens of thousands. I mean, these days you would probably just chat GPT it or something, but
yeah, well, the world has definitely changed in a lot of ways. But yeah, I think there's definitely times where we help. One of the questions I think you had is a public-private question, and it's obvious. I think sometimes how bankers help in the public markets, right? Because that's all kind of published and all the deals are announced and the banks are announced. In the private sector, a lot of times, companies need help, even like with early things like building their financial model and or talking to, they're doing a private round, so not anything in the public, and they're not hiring banks, but they need to in some way justify to their investors why do you think this is a right valuation for a private valuation, right, for your round. Even just recently did an exercise for a private company here where we basically looked at here's who your comps are, here's when. If you go public in a year, here's what we kind of think your valuation might be backing into it. So that kind of helps support a private round valuation right now. So we do a lot of those other things. And like you said, we have a lot of good resources on the research side of the world, and a lot of information that comes to our sales force. And so a lot of those things I think could be helpful to companies. And these days too, even more so, there's a big change in the world that happened since I've been in banking, right? When I started in banking, there were venture capital private investors. They were a very distinct group. And then there were public investors. There wasn't a ton of overlap. There were maybe a few we called crossover, like Orbimed back then but most were very separated, right? And when private companies did their IPOs, their venture capital investors put up maybe 20%. And then your IPO is to go out and find everybody else. That world of investors has essentially merged now, right? The biggest funder of private companies, especially these Series A, B, C rounds, are guys like RA Capital and, folks like that, right? Who are public investors, right? And so that crossover has changed significantly. And what that means for private companies is, it's valuable for them to go to, for example, our conference in Newport, Rhode Island in August, because you are there with a bunch of public side investors who might be investors in your next round, who might be investors when you go public that you want to talk to. The way that banks facilitate the introductions between management teams and investors has changed, but it's still probably one of the most valuable things we do for, everybody who sits in your seat.
When it comes to like private side financing versus public side, I mean, public side, obviously people will just go through the banks, or maybe not obviously the people who haven't been on that side, but people go through the banks. They're not really facilitating the transaction on their own. It would be very strange to try to do it on your own.
There's a few direct ones every year, but that's very, it's the vast majority are public transactions underwritten or agented by public.
Exactly. And then on the other hand, on the private side, it would be considered extremely weird to have a bank help actually do the transaction. Whereas like, I think one thing I actually really loved about public, I was like, wow, like they just do this for you. I mean, there's a percentage being charged, but I'm like, it's so worth it. It's so much faster and simpler from a mechanics standpoint. Why do you think on the private side, people have this perception that it's a bad thing if you have a bank helping you? Because that was essentially the reason most private side people won't do it, is like it would be viewed as, oh, you're desperate if you're using a bank to do the transaction. Whereas I'm like, they make the mechanics so much simpler. Why not?
Partially it's history. And then partially it's economic factors. So from a historical perspective, back when the world was very divided between VCs and public side, a lot of the VC community was well known to each other. And so essentially they said, like, we don't want to pay banks 6-7%. We can all pick up the phone as the person sitting on the board of this private company and call 3 or 4 of our other relationships, other VCs, and like bring enough people together that we can get the next round done ourselves. So we don't really need banks to do that. So we're not willing to pay for it. So that happened in biotech before it happened in other industries. In other industries, tech, for example, banks continued to do privates in tech for quite a while. In biotech, that even early in my career, that had kind of finished by the early 2000s. Like it just wasn't really something people were willing to pay for. And the only people there was an adverse selection. The only companies who were willing to pay for it were companies where they didn't have any of those prominent VCs on the board and couldn't get to people. And so they needed a bank. And that is where that stigma comes from. Like, oh, if you're using a bank, it's because you don't have good investors who can just help you get it done, right? I think that's the history part. I think today, and then there's the economic part, which the economic part is that private investments are harder to do. They take longer. And so the economics for banks are a little more challenging. Mm-hmm. These days, though, I would say, while you don't see banks announced on most private transactions, usually there's some helping that's going on in the background, right? What we tend to do is, if we have a private company where we know the team well, we tend to make introductions and try to get them in front of people. We don't get paid for it. We don't agent, but it's all a part of building that relationship. So when the IPO comes, hopefully we've got a better seat at the table, and all our competitors do the same thing. So I think while the perception is that we don't help with the private, I think we do. It's just different, and it's not as formal. Maybe.
Yeah, and I guess the math of it, I get the emotions behind it. The math of it that doesn't make sense to me now that I get it. I'm like, yes, it's a 5-7% fee, whatever the number ends up being. But if you got 10% more at a 10% higher valuation, like it's all paid for. Like, what's the problem? And I think when you do have a systematic process that kind of crams as much investor excitement into as narrow a window as possible, then you are much more likely to get more than 10% improvement on valuation and or proceeds.
It has started to change a little bit, and partially it's because of, again, that, like we talked about, the investor universe changing a little bit, right? The reality is back when it was the VC world was very different from the public investor world. Those VCs actually didn't spend a lot of time even with research analysts, right? Because that wasn't their world. Yeah. But now with public investors investing in private companies, they're used to paying fees on public deals, so they don't really have nearly as much aversion to that. And they're used to speaking with research analysts. So the research analysts back in the day, they needed to know only so much about private companies as was relevant for the upcoming IPOs. Yeah. If you talk to most of our research analysts now, they're talking to public side investors about private companies as well. Yeah. As competitors for the things they hold, as ideas. One of our research analysts has kind of almost a weekly call with the private side of one of the big mutual funds to talk about privates that they're thinking about investing in. Yeah. And does he know them, and does, where they fit in his space, et cetera.
So for the sell side analysts, I feel like it's an interesting dynamic as far as the incentives. Because on the one hand, like if a bank works with someone and, takes them public or does a secondary transaction, they end up covering them. So obviously they have a huge reason to say, oh yes, this is a buy. Yep. And so how do investors deal with that when they speak to the sell side analysts? Because if you cover them implicitly, they've been paying you. And so obviously you have to say positive things, which, I'm sympathetic to the problem, but like, how do the sell side analysts have to balance that to make the investor side trust them when they also know that, hey, I'm covering them because they transacted with us?
Yeah. Yeah, well, it's a good question. So if you took an IPO candidate, just because it's probably simpler there to start with, but this is true for public companies as well. When we do a transaction, we've already had to go through committee, and research has already had to speak, right? So like we wouldn't, and I don't think any of the other banks would actually be on a transaction for a company where research wasn't supportive. Yeah. So that's a start. So we start with research being supportive.
But the next milestone was shit.
Exactly.
And research and their hardware, like, exactly. But they still got to say bye.
Yes. So here's what I think. If you talk to any public investor, I think they would tell you they don't. Their discussions with the research analysts, they kind of use them for due diligence. They use them for kind of competitive intelligence, if you will, understanding the space a little bit. They use them to understand what other investors may be saying around this name, what other questions are coming up, things like that. I don't think they really care that much about their target price or their recommendation. Okay. You know what I mean? Like, I don't think if you're a public side investor who's spending your time analyzing these companies and thinking about valuation, I think it would be a dereliction of your job if you just said, okay, I should pay, Paul Matisse says it's worth $20 a share, and so I should buy it for anything up to, like, I don't think they care so much about that. Yeah. I think they care more about using them as sounding boards and getting information out of them. And so I think for the research analysts, the goal is to make sure they stay credible, right, with those investors, and that their voice right? That investors do want to call them and ask them about the space and what they really think and why they think this company's better than this one or this has more likely chance of succeeding and why X is different than Y. That's a lot of, I think, the discussion our guys have.
Do you in general think biotechs are better off being public or private? I mean, I know it's a stage dependent thing too, but let's say someone that's in phase 1 trials for the therapeutic side and they're on the verge of having a clinical readout. Do you believe they tend to be better off being public or private in those situations?
There's a lot of caveats to this. I would say generally, I think companies are better off being public in biotech.
Yeah.
And part of that is when you have a data readout in the public markets, you can actually get rewarded for that, right? Your valuation will go up and et cetera. Having said that though, there are definitely, like, you can get caught as a public company in a very small, you have a setback or whatever, or you're in an area where for whatever reason people aren't that interested and you wind up at kind of a smaller cap. It's hard to finance. That's a difficult situation to be public in, right? So there are times when being public is not a huge advantage.
Yeah.
And I think if you have, if you're a long way from any real milestones, that's hard. Like one of the things that happened during COVID, a lot of companies went public at very early stages, right? Even a year or two before they were even going to be in the clinic, right?
Yep.
And, a lot of those companies that there was some euphoria on the investor side, were able to get a lot of those those companies public. But then, 2 years in, their stock prices had drifted down because they weren't even in the clinic yet. They were still early stage and the market had changed, right?
Yeah.
Nothing that the companies had done wrong, but the market had changed significantly and people weren't rewarding early stage companies. And your first milestone was we filed our IND and a lot of the investors were like, we would never have paid what we did before if we didn't assume you were going to do that. So that's not really a milestone, right? Safety is not really a milestone. So you got to actually get, so people were, 4 or 5 years from it. I think that's a little hard to be that early, right? As a public company, because you don't have the milestones to sustain the discussion with investors and keep people interested.
I mean, I agree with the benefits of being public. Why do you think so many private side people are afraid of going public or being public?
I think
both management teams and boards.
Yeah, well, on the board side, I think most boards, it's more about the discussions we tend to have, especially when people get to a point where they could go public.
Yeah.
Is more about like the timing, not whether to do it or not, but the timing of doing it.
Yeah. I'd argue you're afraid of it if you're going to over-argue the timing of doing it.
I don't think they're afraid. I think sometimes when investors don't want to go public, it's because they really feel like the company can get sold and they don't want to take the dilution. Mm-hmm. And they think they can, and they're also, I think there's also a feeling like we can negotiate a good enough valuation. We don't need to be public where we're subject to, ups and downs in the market when we negotiate our valuation for our takeout. I do think there's some of that, how close is M&A factoring in, and could we keep it all ourselves and sell the company and realize that gain? So I think there's always a lot of dynamics going on when you have that conversation. But I think most investors who sit on boards of companies that are at least where they're in the clinic or close to significant milestones where there's a logical discussion to say, should we be public or should we not? Most of the investors, it's really more a debate about timing than anything else. I think for management teams, it's maybe different. I think if you're a management team and you've been public before, most of those management teams I work with, they're not really concerned. They're familiar with it. I think if you haven't been public before, that is a little bit, it's a different world you operate in. Everything you say on a stage,
needs a disclaimer at the start.
Exactly. Needs a disclaimer and people are watching it and, that sort of thing. So I do think that's a if you're not used to it, that is a little bit intimidating.
Yeah. Well, and I also think some of the process, it's, board and management teams can be a little bit different, but like they're a little scared of it because they really hate the idea of they go public and then the stock drops. Yeah. Like if you could guarantee that the stock will go up, like forget your milestones and everything else. If you're like, I know I can promise you that the stock will go up the first week after you're public, I think they would all be like, oh, hell yes, forget the milestones.
Which is funny when you say that about, like, because most of those people are locked up for 180 days.
I know, but
right?
they don't understand. They haven't thought about that.
So they can't sell anyway, even if they wanted to, even if it went up 100%, like there's nothing they can do.
Well, I think it's also, one of my old board members had a good way of putting this. It's like the cocktail party test where if you're a board member or a management team member and you're like at a random cocktail party and you meet someone and they're like, oh, I work at company X. If company X is public, you know they might be looking up your price and judging you for it.
Yes.
For what they know nothing about what you do or anything, but just the stock trend, they're immediately going to judge you. But when you're private, you can say whatever the hell you want. Like, oh, we're all successful even though we're about to die tomorrow. And so I think that's the other thing.
It is true. You're
like.
under much more of a microscope as a public company.
Yeah, there's like a public record of your scorecard.
Yes.
Whether or not that public record you'd argue is accurate or not. But I think people don't like that. So if you can guarantee the scorecard was green,
yes,
every single one of them would do it.
I think that's called market manipulation. Yes.
Yeah. I'm not saying you should try to get thinking about like the investors that get interested in biotech. Why do you think generalists tend to be so weary of biotech? I mean, I know there's times when they come in, times they're like, screw this, we're out, but they'll always hang out in tech or whatever. Why do you think biotech is such a controversial one for them?
So in biotech, I feel like we're lucky. We have a large universe of healthcare specialist investors, right? And you met a lot of these. Many of them are MDs, PhDs, right? They really they understand science. They're equipped to understand what the clinical risk is, understand what the rationale for why something might work or might not work.
Yeah,
understand the end markets and all that, and they know FDA regulatory processes, all these things. And so they're in a good position to be able to evaluate whether this is something they want to invest in or not. Right?
Yep.
I think with the generalists, the issue is that biotech is complicated. A lot of them are not scientists. And so getting into biotech in a big way is challenging, especially smaller or mid-cap biotech, right? Like, could you buy Gilead or, something, of course, right?
Yeah.
Vertex, et cetera. But like getting into, a smaller or mid-sized, especially a clinical stage company, they're not really well equipped to understand the scientific, the science and the risk.
Yeah, because the valuations swing on data, not on, let's say, financials.
Exactly. It's not an earnings story. As you know, like when you're a public company in the development stage, the most important thing you report every quarter is just your cash balance, right?
Yeah.
Like people, your revenue, your net, like maybe your burn, right? Yeah. But really it's all about like how much cash do you have left, right? Generalist investors, that's just harder, right? Because the metrics for investing in the company are more scientifically oriented, and that's not their background. Now, what tends to happen though, right, is as with all and generalist is an interesting, people talk about generalists. The reality is that in biotech, even the big mutual funds, the Fidelities, the Wellingtons, the T. Rowes, they have biotech specific funds. Yeah. Run by guys who, again, who are people who have scientific backgrounds. So that's what they do. And so what we tend to see more when the market gets better and and biotech is outperforming the other sectors, and so the bigger fund families, the generalists and mutual funds, are trying to allocate more money to a sector that's performing well. What we tend to see is that we tend to see orders come in from Fidelity, Wellington, T. Rowe that are bigger than they used to be. And behind it is that they're not all going into the biotech fund anymore. They're going to put this stock in the small cap fund or some other more generalist fund, if you will, or growth funds, et cetera. And so that kind of is the first indication that we're growing the pie a little bit. And then we start to see some of the more true generalists like American Century and people like that, right? It's easy to say a generalist investor, but I think that is kind of a misnomer in some ways.
No, that's fair. And because there's a spectrum of them, but are there things that you think can help structurally shift that positively for the field, such that just the average money allocated over time to biotech goes up relative to other sectors?
What's happened over time is we have more and more companies that are getting later stage and commercial. Yeah. And I think that's easier for the more generalist investor, less scientific investor to be able to invest in companies that are, commercial, and where it does become more about like, okay, what's their end market and how much are they selling this quarter? What's the growth trajectory? And so I think the more companies we get to those later stages and the more investment opportunities there are there, I think that expands the pool for the generalist, larger cap investor. I think the small, like, I don't really think, I think the only thing that causes generalist money to come into smaller cap and more risky stories is when the market starts running away and they feel like they have to participate, right? And usually that ends poorly, right?
Yes.
2 or 3 years down the road.
Because they pull the ripcord real
exactly,
fast.
exactly. And then it goes away for 5 or 6 years until those people have forgotten that they did that, and then it happens again. As we get more later stage stuff, you will see more of those companies held by more generalist funds. Maybe that does free up money for the biotech specialists. I would say though that the healthcare specialists, and especially the biotech specialist funds, size of orders that come from those funds now is significant, right? Like what we always joke about when I started, an order from a RA Capital, not to pick on RA, but they've been around for a long time and a great investor. And a big order from RA was like 3 to 5.
Yeah.
Now, RA has $50-100 million in companies easy. That universe, the amount of capital that they manage has increased significantly, and therefore the size of investments that they make has gone up. And that's been a big change as well.
Yeah, because like one, I don't know, pet theory I have is if we were better at capturing the imagination of the average public, I don't mean public investor, just like people out in the public, that might help too, because I think tech type stuff is so accessible to, your grandma, your cousin, whomever, whereas what we do is so amorphous to them. But they will invest, or they will like pick their funds accordingly. And if we were just more accessible to them, then they would divert more in this direction, and it would become like a self-reinforcing cycle, because then there'd be more of a boost to the zone. Generalists might find it more interesting. Or do you think it's too dangerous to be that much more in the like public eye the way tech is?
I actually think that biotech in some ways doesn't do a good job of promoting itself to the public. Right. And when you hear things in the public about biotech, and that it tends to be pharma pricing discussions.
Well, we're way too nerdy on the science, so they just tune us out. They're like, all right, weirdos.
Exactly. Like if you think back about HIV, right, that it was going to kill everybody. People were knitting, the quilt on the lawn in Washington, D.C. And now it's, if you have HIV, you're most likely to die from the same thing that you and I will, a heart attack or a car accident or something like that. As an industry, we basically created something that was a death sentence into a chronic disease that you won't die.
I mean, COVID being the recent example, and
COVID is a great example. But people, and I think hepatitis C, and there's a lot of those areas where there's certain kinds of cancers where survival rates now are 90+%, right? And we don't do a good job of promoting that, right? Those success stories. Instead, the things that come out about the industry are all about pricing. And,
we have the cure the cancer. We're just not going to give it to people.
Exactly. Which is like that. Just
my grandma thinks so. No matter how many times I tell her no.
I guess conspiracy theorists are going to be conspiracy theorists.
Exactly. So getting back to some of the more people side of things. When people are trying to go public on the management team and board side, what are the things you think they most often need like some education on before going public? And are there things that they should be asking, but you sense that they're too embarrassed to ask those questions? Because I definitely saw quite a few of those in our experience.
The biggest transition from the private to public, especially if you haven't been on the public side before, is just getting used to the idea that you are in the public spotlight, right? The disclosure that we do for an S1, you've been through that process yourself, right? You really have to kind of lay it out and lay out rationale and what you're doing and that sort of thing. And there's, I think a lot of private companies and management teams are not used to disclosing that much, right? And right now there's even a pull the other way, right? In that there's a lot of concern about biotech companies in China, being very quick to copy, and create their own molecules. And so more recently, we've had many companies say, like, we don't want to reveal even our targets, right? We don't want to put anything out there in case a company in China decides to copy it. And so there's this feeling on the private side that if I could keep things private as long as possible, that's probably good for me. And that's totally understandable. On the public side, you really can't do that. Right. And I think that's the biggest transition is people getting used to it. Where public companies, we now have a different standard that we are held to for our disclosure, for what we say at public speaking engagements, et cetera, et cetera. And so I think that's the biggest thing. I think most of the companies I work with, we get into we try and set up situations where we can have one-on-ones with management teams and just say like, for example, we were part of an IPO just a month ago.
Yeah.
And we had a call. We weren't the lead bank on it. We were third or fourth in the book. But we set up a call the week before the IPO with the management team. Just said, look, here's what you should expect from how the next couple days is going to go. Here's here's the kind of things the banks will tell you on the update call. Here's kind of the questions you should think about asking, right? Like about why is this investor interested? Who has he talked to? That sort of thing.
Yeah.
Because one of the things that people I think don't realize is you go through this process and you get an order book, hopefully with a bunch of investors who want to buy your deal. And usually there's more than enough. And so then you have to decide how to allocate it. The banks, as part of any of these processes, IPO, follow-on process, they're having discussions with the investors, but they're also in touch with the research analysts, say like, which investors called you and asked you about this, right? Like, and so we're collecting information. How many did this investor meet you twice on TTWs, called our sales desk and asked about the deal, called our research analysts, so that like they've actually been doing work, right? Yeah. They care here versus someone who hasn't done all those things and puts in an order at the end because they think the deal is going well and they think that there's upside to it.
And I think a lot of that mechanics is what the teams don't get.
They don't understand.
Yeah, because I remember like, people's requested allocations, like maybe it'll say 10 million, but you're like, no, really, that's more like 2. Or really, that's probably not even real. I'm like, wait, how does this thing even work?
Yeah. Well, and that's part of the goal for the banks is to make sure that when we do a transaction, obviously, that transaction does trade well, right? The last thing any of us want is that we price a transaction and it's down 20% on the first day. Like we're all going to hear about that as well.
Yeah.
And so
like an IPO that happened on Thursday, Friday.
Last week.
You guys weren't on that one.
we were not part of it. All of us want to put the stock in the hands of investors who really want to own it and are believers.
Yeah.
The goal is to cut everybody back a little bit so that they buy some in the public market to support the price, right? So there's part of that to avoid kind of fast money, if you will, where it's just going to turn over, right? And so there's work being done on our side as well as the companies, as they go through the process, they should make sure they're thinking about which investors do we want.
Yeah.
One of the things, and this because you've been through it, most of a transaction for a public company in a good market, still 60% of that is on average coming from existing investors. People already own the stock.
Yeah.
Right? In a bad market, like 90, like we had early last year in 24, like 90+% is coming from your existing investors, right? They're saving money to keep funding the companies they believe in. So that group of investors who gets into your transaction, whether it be in a follow-on or whether it be in your IPO, like that's a very important group of investors because they could be your foundation for many years, right? Like every time you report something good, the stock goes up, you go back to raise some more money and those investors participate again, right? So they're kind of your foundation. So it's very important to get that part right for the long term, right?
Yeah, no, that makes sense. And are there traits you've seen in C-levels that made them successful on the private side, but were liability on the public side?
Good leaders on the private side can be very good leaders on the public side as well. I think what tends to happen for a lot of companies if they're successful is once you get on the public side, if you're successful, valuations go up, you are able to raise capital and your growth starts to really increase.
Yeah.
And so, I think for a lot of management teams, it's managing that growth. If you have success is probably the biggest challenge that comes.
Sometimes one of the challenges, which relates to some of the other differences from private to public, is that people that may have been a little over exuberant with how they would describe things, they can get away with it on the private side.
Yes.
But on the public side, there'll be consequences. Because I feel like, I don't know, like for some of my friends, I describe it as private side, like you're being judged by a series of snapshots. Like you're raising, people are looking at you. When you're not raising, they're not really looking at you. And then they'll look at you again.
Right.
Public is a movie.
Yeah.
They'll rewind it. They'll rewatch that other part. It's like, you better freaking get it right.
Yeah, no, that's very true. CEOs who I think handle that best, and the more experienced CEOs I think have gotten used. It is in biotech, it's not seen, and you kind of refer to it with how we approach the in the public generally, but it's not seen as a positive to be really promotional.
Yeah.
It's seen as a positive to be kind of conservative, if you will, and practical, right?
Yeah.
We ran this trial, we did this trial. Here's what we learned. Here's what we still have to answer, right? Like that kind of mentality, rather than we ran this trial, it was great. Like everything was great and blah, blah, blah. Like
cancer's cured.
Exactly. Investors look at that and, and you see it, right, when companies have trials where the trial wasn't actually successful, but the top line says, successfully completed, whatever. And then the investors look at it like, you missed your p-value. Like, right. Like, you're right. But I think you learn that over time. But that's hard for private to public because your analogy was spot on, I think, right? Yeah. It is very, public CEOs, especially public CEOs who are approaching a data event, right, will tell you, right, they go to, there's lots of investor conferences. And so they go to investor conferences 3 weeks in a row. Yeah. And the same investor signs up for a meeting at all three and asks the same questions and just wants to see if they react any differently. Like if they blink when they ask a question or look away or and they're reading into all sorts of things. Yep. So it's very different.
No, I feel like some of the public investors are basically like human lie detector. That's all they're doing.
Yeah.
Is you said you don't know, but I know it's open label, so you know more than I do. Well, and I'm waiting to see the underlying reaction.
Right. And the other thing is, as that public investors are not shy about telling you what they think, right? Yeah. And if they'll tell you how you think, some of them, not all, but some of them will tell you like, we think you should report this way. We think you should talk about this. We think you should talk about that. And so I think you have to have a little bit thick skin as a public biotech CEO because you're out there publicly and because people are invested in you, a lot of people are going to have opinions about what you should be doing. And so I think you have to, have quite a dedication to and a belief in what you're doing and an understanding of what you want your message to be. Yeah. And sticking on that message, right?
Yeah. The Mark scoring card. What do you think are the best correlates to people are going to do well versus people whose situation is going to crash and burn down the line?
Data.
Okay.
Data saves everything. Like I work with so many people who I think are really good management teams, and unfortunately their data hasn't worked out. And so sometimes, bad things happen to good people, right? Yeah. Even though all the rationale, like at the end of the day, biotech companies are running, experiments. We call them clinical trials, but they're experiments, right? And they're trying to prove something, but you don't know. Otherwise, if you knew, you wouldn't have to run the trial, right? Right. And so sometimes bad things happen to really good people. And the flip side of that is true too. Sometimes like someone you met and you're like, wow,
man, I really don't like them, but
and they have great data and their stock zooms and, good for them. But it's not, so I think it can go both ways. And obviously all the management teams are trying really hard to, work on good science and set up clinical trials that are likely to prove what they're trying to prove. Yeah. But, there's always things that are unexpected.
Yeah. And if you could, wave a magic wand and change something about our ecosystem, what would be the thing you would want to change? Anything about it?
Maybe I can have fewer competitors.
Your guys is, I feel like bankers don't often get as much sympathy, but I will say, you guys work a lot and it's insanely competitive, and it seems so perception based too. It's certain brands, if they come knocking your board, it's like, oh, yes, they can have the IPO. I'm like, but they've done nothing. This other group did everything. They're like, nope, doesn't matter. Their name.
Yes.
Just do it. And because I also think when things go down, because your guys' world is so based on transactions happening.
Right.
That's the only way you guys get paid essentially. When all that dries up, you're like, oh, okay. But no one's thinking about that.
All of us are trying to find ways to be helpful to our clients, right? And so, even in more difficult times, and I had to work on a couple of bankruptcies in 2023 because we have a very good restructuring group. That's not something you ever really want to do as a banker. Then none of those companies wanted to be in that situation. That was the situation they were in, and so we found a way to help, right? I think the biotech world is a fabulous place. I think that over time, the tools and such that you all use, I think, have improved the quality of the science and the quality of the clinical trials and, much. I think the regulatory situation is very difficult right now. Investors are trying to get their arms around it. I'm sure companies are as well, with all the changes at FDA. I think that would probably be the biggest thing. If I could change one thing about the ecosystem, it would be, having the FDA be, not a walkover, but being more, as I feel like they were maybe even 5 years ago, partnering with companies to try to figure out like, okay, this is an important disease. How do we help get this to the finish line and help prove that this works and justify approving it? And I feel like that some of that has gone away.
Yeah.
Right.
No, that's a good one. All right. Last question. What's a belief about bankers and biotech that you feel like people really misunderstand? And if you could change that, you would.
I don't know. I think it's a little bit like you said, right? Like we're all human beings. Like, like everybody who's at that situation, who's a CEO at a biotech company or CFO, like got wife and kids or a significant other and kids. And like, so and also like a lot of the other bankers at the other banks, I get along with really well. Like I ride the train, like, so we're competitors per se, but in a lot of times in biotech, especially, we're on the same financing transactions together and we're working together to get something done for a client. So there's a lot of, while we compete at the beginning to get our roles on transactions, once it's agreed on, then we're all working together.
Yeah.
And that's the part that I actually like much more than the piece before it, and all the economic negotiations, which is probably the worst part of my job, honestly.
That is the worst.
It's the worst part. I didn't get into it because I feel like
most people wouldn't understand it.
Yeah. And we don't need to go into it, but that's the worst part of my job by far.
Yep.
But yeah, I think there's a lot of good people out there doing what I do who are trustworthy and who can help companies.
Yeah. Awesome. Well, thanks again for joining. Definitely appreciate it.
Thank you for having me.
All right. Cheers.
Cheers.